The federal government is holding money with your name on it right now, and by law they are not required to notify you that it exists. They will not call. They will not send a letter. And for every month you continue watching retirement content that doesn't tell you what I am about to tell you, a portion of what you are legally owed becomes harder to recover, and some of it disappears permanently. I want you to stay with me through this entire video, because by the time we reach the last benefit on this list I am going to tell you something that has been quietly generating money in the background for certain retirees without them ever knowing it was happening. And I am going to tell you exactly what to say when you pick up the phone. A retired public librarian named Carol Simmons from Shreveport, Louisiana sat down with her daughter last spring to go through her monthly budget. Carol is 71. She worked 32 years at a parish public library, retired at 66, and pulls in about $1,400 per month from Social Security with a small supplemental pension from the Louisiana State Employees Retirement System. Her Medicare supplement premium runs $186 per month. Her 3 maintenance prescriptions, blood pressure, cholesterol, and thyroid, cost her an average of $210 per month out of pocket. Her property taxes increased again last year. She earns too little to save anything meaningful and too much, she assumed, to qualify for government assistance. Her daughter looked at the budget and asked one question: has anyone ever gone through these programs with you? Carol said no. No one ever had. Carol has been leaving roughly $9,400 per year on the table since she turned 65. Not from bad decisions, not from carelessness, but because the system that was designed to help her required her to come looking for it, and nobody pointed her toward the door. Before we go through all 8, I want to flag something now so you hold it in the back of your mind. Benefit number 3 on this list is not a program you apply for. It is money the federal government has legally owed certain retirees since January of 2024, and a significant number of those people have not received it yet. I will explain exactly what happened, who it affects, and the specific phrase you need to use on the phone to get it resolved. But let's build the foundation first, because the first 2 benefits will tell you whether the ones that follow are even more valuable for your specific situation. The first benefit is a set of programs buried inside Medicare that most people never hear about at enrollment because the enrollment process is almost entirely designed around selling you supplemental coverage, not reducing what you already pay. The Medicare Savings Program is a group of 4-tiered federal programs administered through your state's Medicaid office, and their purpose is direct: they pay Medicare's cost sharing on your behalf so you don't have to. The highest tier is called the Qualified Medicare Beneficiary Program, QMB. If you are enrolled in QMB, the program covers your Part B premium of $185 per month in 2025, which is $2,220 per year. It covers your Part A inpatient deductible of $1,676 per benefit period. It covers your Part B annual deductible of $257. And it covers most of the co-insurance and co-payment obligations under both parts of Medicare. You stop paying those things entirely. The income threshold to qualify for QMB is approximately $1,255 per month. For a single person, about $15,060 per year, and roughly $1,703 per month for a married couple. Now here is the detail that changes the calculation for a large number of people who have already ruled this out. In most states, the old asset test is gone. Your home does not count. Your vehicle does not count. In many states, your IRA and retirement savings do not count. That means someone with a paid-off house, a modest retirement account, and Social Security as Their primary income may fully qualify for QMB and may have been paying a $185 monthly premium for years that this program was structured to eliminate. Directly below QMB are two additional tiers, SLMB, the specified low-income Medicare beneficiary program, which pays your Part B premium for people at slightly higher income levels, and QI, the qualifying individual program, which covers Part B premiums one tier above that. You apply through your state Medicaid office, not through Medicare directly. There is no cost to apply. You bring your Social Security award letter, a recent bank statement, and any documentation of pension or investment income. The worst outcome is a denial. I want to say something before moving on, because some of you just thought your income is probably too high for any of this. Hold that assumption lightly. We will come back to it at benefit number 5, because the eligibility rules changed in most states within the last few years, and people who were correctly ineligible at one point may not be today. The second program runs through Medicare Part D and goes by two names that mean the same thing, Extra Help, and the Low Income Subsidy. Extra Help pays your Part D plans monthly premium down to $0, eliminates your annual drug deductible entirely, and reduces your prescription copayments to between $4 and $10 per medication in 2025. The Social Security Administration estimates the full Extra Help benefit is worth approximately $5,900 per year. If you are currently spending $150, $200, or $250 per month on prescriptions under a standard Part D plan, Extra Help compresses that entire figure to somewhere between $16 and $40 per month for the same medications. The income limit for the full benefit is 150% of the federal poverty level, approximately $22,590 per year for a single person and $30,660 for a married couple in 2025. The SSA's own data shows that 2 million people who currently qualify for Extra Help are not enrolled. Carol's prescription bill dropped from $210 per month to $28 after a single phone call to 1-800-772-1213. That is what this program does when someone actually applies for it. Stay with me now, because what I am about to explain next produced more retroactive income for retirees in the past 12 months than any other item on this list. For decades, two rules embedded in federal Social Security law, called the Windfall Elimination Provision and the Government Pension Offset, quietly reduced, or in some cases completely eliminated Social Security benefits for people who also received a pension from a government job that did not withhold Social Security taxes. Teachers in states including Ohio, Texas, California, Louisiana, Massachusetts, and Colorado. Police officers and firefighters in certain jurisdictions. Federal employees hired before 1984 under the old Civil Service retirement system. The WEP reduced retirement benefits, sometimes by more than $500 per month, using a formula that penalized workers for having a government pension alongside Social Security. The GPO went further and reduced or zeroed out spousal and survivor benefits based on the same pension logic. A retired Texas teacher named Patricia Reyes worked 28 years for Dallas ISD, expected to receive a survivor benefit from her late husband's Social Security record, and found the GPO had eliminated it entirely. She received nothing from his account despite the fact that he had paid into Social Security his entire career. Millions of people absorbed these reductions for years and simply accepted them as fixed. They were not fixed. The Social Security Fairness Act, signed by President Biden on January 5, 2025, permanently and fully repealed both the WEP and the GPO. Every person whose Social Security was reduced under either of those rules is now entitled to a higher monthly benefit going forward, and to a retroactive lump Some payment covering the increased difference back to January 2024. The SSA has been processing these corrections, but the rollout has been slow and inconsistent. There are people who were affected by these rules who have not seen a single dollar of their corrected benefit or their back payment. If you ever worked for a school district, a city, a county, a state agency, or the federal government in a position where Social Security taxes were not withheld from your check, call Social Security and specifically use the phrase Social Security Fairness Act. Ask them whether the WEP and GPO have been removed from your account and whether your retroactive payment has been processed. Write that phrase down before this video ends. We are not finished with Social Security yet, because benefit for lives in a part of the system that divorced people almost universally miss throughout their entire retirement. If you were married for at least 10 years and are currently unmarried, and your ex-spouse is alive and at least 62 years old, you have a legal right to claim a Social Security benefit based on their earnings record worth up to 50% of their full retirement age benefit. Your ex-spouse receives no notification. They provide no consent. Their own monthly benefit is not reduced by a single dollar as a result of your claim. The rule exists because a long marriage is an economic unit, and the person who stepped back from their career to hold that unit together, to raise children, to support a spouse's advancement, to manage a household, has a legitimate financial stake in the income generated during those years. If your own Social Security benefit is lower than 50% of your ex-spouse's full retirement age amount, you should be asking Social Security to calculate both figures and show them to you side by side. If you have been divorced for at least 2 continuous years and your ex has not yet filed for their own benefit, you can still claim on their record the moment you are both 62. For people currently collecting a benefit that has always felt smaller than it should be, this calculation sometimes reveals a figure they were never once told existed. Now we reach benefit 5. This is the one I told you to hold in mind earlier, the one that may put you back in the running for programs you dismissed years ago. Senior property tax relief exists in nearly every state, and the income thresholds are consistently higher than most retirees assume when they hear about it. These programs come in 3 main forms. Exemptions reduce the assessed value of your home before the tax rate is applied, so a home assessed at $300,000 with a $50,000 senior exemption is taxed as a $250,000 property. Freeze programs lock your assessed value or your actual tax bill at a base year, meaning that even as your home appreciates and tax rates shift, your bill cannot grow beyond that fixed point. Circuit breaker programs cap your total property tax obligation as a percentage of your income and rebate the excess back to you. In Illinois, the Senior Citizens Assessment Freeze applies to homeowners 65 and older with household income below $65,000 per year. In New Jersey, the Senior Freeze is available to seniors with income under $163,050, a ceiling that covers a wide range of people who have never once considered themselves candidates for a government benefit program. In Texas, homeowners 65 and older have their school district taxes frozen at the level from the year they turned 65, regardless of what happens to rates and assessments for everyone else. None of these programs activate automatically. Every single one requires an application filed with your county. The deadlines vary. Most counties have a spring window, and there is no reminder sent to the homeowner. Search your state's name and the phrase Senior Property Tax Exemption. That search takes less than 10 minutes and can reduce your annual tax bill by hundreds or thousands of dollars for as long as you own your home. We are past the halfway point now, and I want to say something directly. If even 2 or 3 of the benefits covered so far apply to your situation, you are looking at the potential to recover somewhere between $3,000 and $12,000 per year in costs you have already been Absorbing on a fixed income. That is not investment returns, not risk, not restructuring anything about how your retirement is built. That is money the system owed you and that you were not claiming. The three benefits still to come are not smaller or less important. For a specific group of people watching right now, the last benefit on this list has been working in the background for years without them knowing, and I am going to show you exactly how to verify whether it is happening for you or not. Do not stop here. Benefit number 6 is SNAP, the Supplemental Nutrition Assistance Program, and it belongs on this list not because it applies to every senior watching, but because the eligibility rules for seniors are specifically different from the rules for everyone else, and those differences mean a large number of people who believe they cannot qualify actually can once the math is done correctly. For households with a member who is 60 or older, the net income limit sits at 100% of the federal poverty line, about $1,255 per month for a single person in 2025. But before your income is measured against that threshold, a set of deductions reduces your countable income. There is a standard deduction, an earned income deduction where applicable, and most importantly a medical expense deduction that removes all out-of-pocket health costs above $35 per month from your countable income total. For a senior paying $150 per month in Medicare cost-sharing and prescription copays, that deduction alone pulls $115 per month off what Social Security counts as your income for the purpose of this calculation. The average SNAP benefit for a single senior household is approximately $140 per month in 2025. For a married couple with allowable deductions, it can reach $250 per month or more. The Government Accountability Office found in a comprehensive review that 42% of seniors who qualify for SNAP are not enrolled, and the primary reason given was not knowing they were eligible. Most states allow seniors to apply by phone or by mail without any in-person visit. If you have not run the net income calculation using the medical expense deduction, you have not actually checked whether you qualify. The seventh benefit addresses a cost that none of the other 6 programs touch: what you pay to heat and cool your home. LIHEAP, the Low-Income Home Energy Assistance Program, is federally funded and administered through local community action agencies in every state. Eligibility generally sits at 150% of the federal poverty level or 60% of your state's median income, whichever is higher, which in most states puts the ceiling at roughly $22,590 per year for a single person in 2025. The average benefit runs between $400 and $800 per heating season nationally, with higher amounts in colder climates where heating costs are most severe. Some states run a companion cooling component for summer months. Applications typically open in October or November, and because funds are capped, applying earlier in the window produces better outcomes. The National Energy Assistance Referral Hotline, 1-866-674-6327, connects you to the community agency managing LIHEAP in your county. It does not affect enrollment in any other program on this list. For seniors who have been absorbing winter energy bills on a fixed income without assistance, this program exists specifically to offset that pressure. Now here is Benefit 8. I saved it for last because it requires no application at all. It has been operating automatically for some retirees without their knowledge, and for people who discover it is not working correctly, a single phone call can recover income that should have been arriving for years. When Social Security calculates your retirement benefit, it uses your 35 highest earning years, adjusted for wage inflation, to produce the base figure your monthly check is drawn from. If you worked fewer than 35 years, zeros are averaged into the calculation for the missing years, reducing your benefit. But what almost no one in retirement has ever been told is this: every year after you begin collecting, Social Security runs an automatic process called a recomputation. If you are working in retirement, consulting, tutoring, doing part-time or seasonal work, running any self-employment, and the earnings from that recent year exceed any one of the lower earning years currently sitting in your top 35, Social Security replaces the weaker year with the stronger one and recalculates your benefit upward. You file nothing. You request nothing. It happens automatically. The timing operates on a 1-year delay. Your 2024 earnings, for example, typically produce a benefit adjustment reflected starting in your December 2025 payment, paid retroactively and continuing forward. Here is where the problem surfaces. If you have been working part-time in retirement for 2, 3, or 4 years and your Social Security has been completely flat during that entire period, the recomputation may not be processing correctly on your account. Log into ssa.gov, pull your year-by-year earnings record, and confirm that your recent working years appear there with the correct wage amounts. Then call the Social Security Administration and ask them directly to confirm that your annual recomputations have been applied. Some people find years of wages that were never credited from a prior employer. Others find the recalculation was completed but not communicated and is sitting unresolved in their record. A $35 or $40 monthly increase sustained across a 20-year retirement produces between $8,400 and $9,600 in cumulative additional income, from work you were already doing for other reasons entirely. Carol Simmons from Shreveport found out about these programs when her daughter spent one afternoon working through a list exactly like this one. Carol applied for extra help by P. Hone on a Thursday. Her prescription costs dropped from $210 per month to $31. She applied for the Qualified Medicare Beneficiary Program through the Louisiana Medicaid office 2 weeks later. Her $185 Part B premium was eliminated. She submitted her parish's senior homestead exemption form and her property taxes decreased by $740 per year. She did not recover the years she had already lost. But from that Thursday forward, her financial picture changed by more than $9,000 per year, not from new income, not from investment performance, not from anything she had to earn or risk. From knowing what the system owed her and choosing to ask for it. Here is how you sequence your next steps based on where your situation actually sits. If your income as a single person is under $30,000 per year, start with extra help through the Social Security Administration this week. The application is available at ssa.gov or by phone at 1-800-772-1213. The annual dollar value is among the highest on this list and the application is not long. Once that is submitted, contact your state Medicaid office and specifically ask about QMB, SLMB, and QI, all 3 tiers, not just whichever one they mention first. Ask them to run the calculation before either of you reaches a conclusion about eligibility. Then pull up your state SNAP application process and use the medical expense deduction when calculating your net income before assuming you don't qualify. Find your local LIHEAP provider using the 1-866-674-6327 hotline and get your application in before November. Acting on even 2 of those 4 programs before the end of this year will measurably change your monthly cash position without touching any other aspect of your retirement structure. If your income falls between $30,000 and $60,000 per year, start with your county tax assessor. Look up your state's senior property tax programs, read the income eligibility thresholds carefully, and apply before the county's filing deadline, most of which fall in the spring. If you are divorced and your marriage lasted at least 10 years, contact Social Security and ask them to run the divorced spousal benefit calculation alongside your current benefit figure. And regardless of your income level, if you ever worked in any capacity for a government employer that did not withhold Social Security taxes from your paycheck, call Social Security now, use the phrase Social Security Fairness Act, and ask them to confirm whether the WEP and GPO adjustments have been removed from your account and whether your retroactive back payment from January 2024 has been issued. That single phone call takes 15 minutes. The result of it may be a permanent monthly increase plus a lump sum check you had no idea was coming. If you are in the first few years of retirement and still working in any capacity, part-time, consulting, seasonal, self-employed, log into ssa.gov and verify that your recent working years appear correctly in your earnings record. Note your current benefit amount and return each December to compare it to the prior figure. If your Social Security has been completely flat across multiple years of active part-time work with no adjustment at all, call Social Security with your most recent W-2 or self-employment tax documentation and ask them specifically about the annual recomputation process on your account. The federal government built every program on this list. It funded them, wrote the eligibility rules, passed the laws. What it did not do, and what it is not legally required to do, is contact you when you qualify. The gap between what exists and what seniors are actually told about is not an accident. You close it by knowing what to look for. You now know. The next move is yours to make, and the phone number is already in your hand.